A quarterly earnings report can be a make or break moment for a stock. And while the report itself tells a crucial story about the company, it's the investor reaction to those results that's even more critical. Joining me now to break down strategies that help put the odds of success in your favor during earnings season is IBD Market Research Director Justin Nielsen. Thanks for joining me, Justin.
Absolutely, Ali, a pleasure.
All right, so when earnings season rolls around, investors are faced with a key question. If they own a stock, do they hold it into that report? And one big part of that equation is, what does your profit cushion look like?
Yeah, absolutely. I mean, because the fact is, if you're going to be holding on to a stock for a big gain, you're going to have to sit through some earnings reports. And a lot of times with these really dynamic companies, it's those earnings reports that keep investors engaged, and it gives you that feedback that you're in the right company because those earnings reports show the growth. You hear the company report, and how well things are going, and at how the trend is continuing to improve. All of those things kind of give you a little bit more conviction in a stock. And so a lot of times you may be holding through these earnings reports, but if you don't have a lot of cushion, because there can be extra volatility around these earnings reports, you don't want to necessarily be involved with a stock where you're taking on undue risk ahead of that earnings report because you don't have a cushion, and your portfolio could take a big hit if you're not aware of it, or if you're not managing your risk appropriately.
So let's get a little bit more specific about the numbers that we're talking about. Just a kind of a general rule. What sort of profit cushion percentage wise would be ideal as a rule of thumb to be able to stick to?
Well, part of this is going to depend on the volatility in the stock that you own. There are certain companies that, look, earnings come and go, and it doesn't make that much of a difference. There aren't that big of moves, but there's other companies where it can make a big difference. Or there's some companies where the volatility in just its everyday action is enough to where you have to manage your risk. So it really depends on the company. But as a general rule of thumb, we'll use like a 5%, 10% profit cushion going into earnings. That kind of makes me feel a little bit more comfortable, because if we do get an earnings report where things don't go as planned and it comes down quite a bit, having that cushion means that I've got to lose all of that first, and then I'm going to start losing capital. So you want to have a sense of not only how much cushion do you have, but what kind of move is expected in the stock. Because if you're starting to lose not only your profit cushion, but then your capital, that's a situation where you want to be very careful and you want to manage your risk appropriately.
Yeah, Justin, as you were saying, knowing the personality of the stock is very important. So you can look at how the reaction was to the past several quarters of the report to see that personality a little bit in action when it comes to these earnings moves. But to get a little bit more specific about the expected move for the upcoming report, what should investors do?
Well, you don't have to be an options trader to use options to just give you a sense of what is expected in a stock. And one of the ways you can do that a lot of us will use, is we'll use the straddle price of a particular option. And what you do there is you're using an at the money straddle. And so you just take the call option of an at the money call and the premium of a put option, an at the money put. You add those together, and that gives you a sense of what is expected by that expiration date. And so by using that information, and again, that's going to give you a price expectation move. And keep in mind, that can be plus or minus. So sure, it might go up by that much, but it might go down by that much. And so I'm usually looking at my risk factor. So if I don't have enough cushion to weather the storm of that potential move down, then I'm going to be a little bit hesitant to get involved or stay involved with a particular company before that earnings report. Now, if I have a lot of cushion, then I'm going to feel a little bit better if I'm within the expected range of that move.
Yeah, because if that expected move to the downside in that worst case scenario would put you at a 7 to 8% loss on your position, which is a very key sell rule for IBD CAN-SLIM traders, then it's probably not a good idea to be holding a full position heading into the report, unless it's a smaller position. Or what are some of the other things that would help you make that determination if it's on the bubble potentially for that worst case scenario?
Well, you bring up a very good point. Position sizing can make a big difference in your risk mitigation. So if you have a smaller position size, yes, the fact is, if it goes up a lot, you're not going to be participating as much. But you're also, if it goes down a lot, you're going to be reducing that risk because you don't want to take big hits to your portfolio or to any individual trade because it just takes so much, the math starts working against you. The bigger hit you take on that stock, the more makeup ground you have to do. And you can dig yourself into a hole very easily if you let a loss get away from you. And sometimes that's not anything that you could have seen coming. There's some of these reports, it comes out and there's a big change in the way that it's being valued, either to the upside or the downside. And so, it's that downside risk though that we have to be very careful of, because if you get a stock that goes down 10, 20% and you didn't have any cushion, well, clawing your way back from that is going to be tough.
And calculating that expected move is one thing, hypothetically, but let's talk about the reality. How often are these expected moves in range with what actually happens?
Well, and again, this is where I think you had a great idea. One of the things you can do is look at historically, what kind of price moves has the stock had? Look at the last year or so of earnings reports. What kind of move has it had? You could look at the historical options market and see what was the expected move? How often was it kind of coming into that range or falling outside of that expected move range? And that'll at least give you an idea of what you're dealing with.
One final thing on taking profits heading into the report. So even if you do have a cushion, sometimes you may just want to take some profits into strength ahead of the report. What do you think about that?
Yeah, and here again, a lot of times will depend on how much cushion do you have, how much risk do you have. Let's say this is a stock that has appreciated a lot. It's become a larger position in your portfolio as a result. Well, you might want to just take some off the table because of that, by itself, just to kind of put it more in line with a normal size position instead of an outsized position. Now, if you still believe in the prospects and you're, going for a home run on the stock, then maybe you allow it to kind of continue that momentum. And as long as you have a big cushion, then yeah, you're going to take some off the top if it doesn't go well, but you're still, again, managing your risk. It's very different when you're playing with house money instead of the risk of capital, your hard-earned capital. That's where we shy away from that a little bit, because again, we don't want to get to a point where we're potentially losing 10%, 15% or more from our purchase price on a stock, because that's, again, one of those things that can be very hard to recover from. But if it's one of these stocks where we've got a lot of cushion on it, it's well above its 50-day moving average line, well, we're going to have some expectations that a normal pullback to the 50-day, and that might even happen around earnings. There might be a little bit of jostling there. But here again, it's really going to depend on your own portfolio management style, how comfortable you are with larger positions. And as we always say, it doesn't have to be an all or nothing proposition. You can sell a little bit ahead of earnings. Sometimes we'll make sure we only have a half position, or in some cases, we'll even go down to a quarter position so that we still are retaining some of the low average cost shares, but we just aren't taking that big of a risk to our portfolio. And sometimes the market is going to be a factor in there as well. How strong are your convictions with the market itself?
Exactly. Yeah. Justin, thank you so much for that comprehensive breakdown. We really appreciate it. It's extremely helpful for investors as they make their earnings season battle plans. So thanks again.
You got it.
And coming up next, NFTs, or non-fungible tokens, are getting a lot of attention right now. And Loop Ventures is here to discuss everything investors need to know about these new assets. That's right after the break. Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.